This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Hey, now to the other stock that's definitely on our radar. It is nearly 2% of the NASDAQ 100 and more than 10% of the New York Stock Exchange's FANG Plus index. We're talking, of course, about Netflix, soaring today, up 11.8% now to its highest in more than 2 years. And that's what happens when it shows it can do what it did during COVID. And when we were all stuck at home binging on Tiger King, Queen's Gambit, Squid Games. Did you watch that one?
I did not.
Okay. It's a little squeamish, okay?
Yeah.
And more. Just a reminder, Netflix reporting its best quarter of growth since viewers were stuck at home in the early days of the pandemic.
All right. The company, you know the number, signing up 13.1 million new customers in the final 3 months of 2023, exceeding Wall Street's estimate of 8.91 million. So it was a big beat. And in fact, it beat projections in every region of the world. We've got a great guest, Tim.
Yeah, Michael Pachter is joining us. He's managing director of entertainment and analyst at Wedbush Securities. He joins us on Zoom from Long Beach, California. Michael, good to have you with us. Good to talk to you again. I mean, this is a company you've been covering for more than a decade, and your view has certainly shifted. Let's talk about where your view is right now. You've got an outperform on the stock. You've upped your 12-month price target to $615 from $525. Not quite a street high, but you're among the highest, according to the analysts that are tracked by Bloomberg. Why the upgrade?
Well, I've covered it for 20 years in August, actually.
Wow.
We had a sell on it from roughly $10 to $6.90, so wrong for 10 years. And
ouch.
And then I upgraded at $180, and we put it on the best ideas list at $330. So what I'm seeing is what I criticized 10 years ago or 13 years ago on the downgrade to sell. I'm seeing them do what I said they needed to do, which is stop being fixated on adding subs at all costs and start focusing on profitable subs. They're doing everything right. They're managing their spend properly. They're shifting their budget more toward television, away from movies. You saw Scott Stuber left the other day. They are shifting their budget more toward international production, which costs about half as much as domestic. They are far more international. And what you're seeing now is that subscribers are coming in at very, very high margins. You're seeing operating profits expand materially, literally 300 basis points a year, which means they're going to make a lot more money than anybody thinks in the next several years. So they trade, a 20 something multiple. We have a 30 multiple price target. Could I be at 40 or 50 or 60? Sure. It really depends on how fast.
Hey, Michael, we want to bring up a chart for all of our viewers, and it shows just the blowout number of subscribers added in that last quarter. It looks like it could, pull back a little bit in the next quarter in a big way. But as you were saying, it's not just the net number of subscribers, it's that the folks that they are signing up, they're making more money off of them.
Absolutely. And, if you see that 13 million number, new subscribers, 40% are signing up for the $6.99 ad-supported tier, but they're generating about $16 because the ad load is about $10.
Nice.
So, they've shown that by lowering price and adding advertising, they're attracting people that couldn't afford $15 before. The balance of those people are largely coming from password sharing crackdown.
Yeah.
And, there are people whose kids, their adult children or their parents.
Tim's brother included. We're just going to share that. We've shared that several times on air. Sorry, Tim's brother.
And again, that has a double whammy. The people who shouldn't be using it are signing up on their own, and people who you want to pay for, my kids who are college grads, I'm paying for them. I pay for their cell phone. I'll pay for their Netflix subscription. So that expands average revenue per member, and it expands new members. You're seeing it all just dovetail nicely. And now they're doing something clever. They're adding gaming. They finally have figured out how to do it. And that makes the service stickier. You're less likely to quit if you've been on the Netflix service in the last month. Stuff like Grand Theft Auto Trilogy gets people coming back.
Hey, Michael, you're also a gaming analyst, we should note, so you covered this stuff really closely. What is Netflix doing that the other companies are not doing, that, the Disneys aren't doing, the Paramounts aren't doing, the Peacocks aren't doing? Like, why is Netflix executing so much better?
First mover advantage is the biggest thing. They've kind of created the fund that would buy licensed property, would license things like Suits, from the other networks. The other guys were trying to go all proprietary all the time. So CBS content stayed on Paramount, and NBC content stayed on Peacock. ABC stayed on Disney Plus, and they didn't have the critical mass to actually support giving away all that content without collecting subscription revenues. Netflix has 260 million subscribers. They can pay up. They did this for WWE. It's a perfect example of something they took away from USA Network, and now they're going global with it. Their idea is we're taking something that has an audience of fewer than 1 million people a week, and we're going to expand that to 5 million people. And when they do that, they leverage their subscriber base. They can afford to pay more. The network, or in this case, WWE, says, of course I'm taking more money. So the other guys are being dumb. Peacock, okay, right. $110 million for one game so we can all see Taylor Swift one game. Dumb. Really dumb. I know they got 3 million subscribers. All those people are going to quit in another 2 weeks.
Hey, no dissing on Taylor Swift here. Hey, having said that, Michael, that's fair. We all do. Hey, listen, we've got just about a minute left here. So you obviously are upbeat. You like the WWE deal that they just did, and they kind of front ran earnings yesterday in a big way. Having said that, what would make you turn bearish again on Netflix? And again, just got about 30, 40 seconds.
Valuation. I mean, if the stock gets to, much, much more than it's worth, of course, I would downgrade. I am very comfortable at 615. I probably could be comfortable at a higher number if I see greater earnings growth than we have forecast. But, if the stock ran to 2,000 or 5,000, of course, I would downgrade.
All right. Michael Pachter. Hey, you know what? It's okay that you pay for your kids' Netflix, okay? I'm just throwing it out there. That's fine. You're not the only one who does that.
Your kids are older and you're paying for everything.
I'm just wondering if the other streaming services are going to wise up soon to, crack down on password sharing the way Netflix has. Listen, I get the sense they are, but it's going to create a lot of changes in households.
Well, talking with our Gita Ranganathan yesterday, I mean, this whole idea that Netflix has figured out how to pivot, right? From when they used to be, the little red boxes, and that you put them in the box.
The DVDs you're talking about? The little red boxes?
VHSs?
They didn't ever do it. They didn't ever do it tapes. No, they were all DVDs.
It just feels like they did.
They did pivot a lot.
All right, you've got Netflix shares, folks, up almost 12% in this session. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Once again, as you know, politics are front and center. As you know by now, former President Donald Trump put himself on the cusp of clinching the Republican presidential nomination after New Hampshire voters handed him a decisive victory in Tuesday's primary. We just talked about this with our Joe Matthew.
Yeah, President Trump, former President Trump, I should say, comfortably dispatched his only remaining challenger, former UN Ambassador Nikki Haley, a little more than a week after his romp in the Iowa caucuses forced his other main rival, Florida Governor Ron DeSantis, out of the race.
All right, so the back-to-back wins putting the former president, Donald Trump, on track to deliver a knockout blow to Haley, Nikki Haley, next month in her home state of South Carolina. And then, of course, he turns, Tim, his attention to an all-but-certain rematch with President Joe Biden.
Well, a voice we wanted to get to and hear from again, the interview this hour, who was on with us at the beginning of the year to talk all about the firm's top risks, predictions for 2024 in a year that the organization labeled as one of, quote, grave concern. With us again is Eurasia Group Chairman Cliff Kupchan on Zoom from Washington, D.C. Cliff, good to have you back with us. Has your view changed at all over the last couple of weeks, given that it's increasingly looking like former President Trump will go head-to-head with President Biden?
Our view hasn't changed, but, the movies, we're watching the movie now. He's very, very powerful, and he made that clear in New Hampshire, though I do think polling data from both Iowa and from New Hampshire shows, he's got a pretty low ceiling. He's going to have trouble getting independents, and he needs them to get over the top. But I think people are going to start to realize, if they haven't already, when Haley drops out, I think she'd run a great campaign. I would be surprised if she makes it to the South Carolina primary on 24 February, where she's going to get really beaten if she does, beaten badly. So he's got the nomination, and I think what we wrote about is starting to happen.
Hey, Cliff, we were struck when we talked to you earlier this year at the kickoff to 2024 that the number one risk in the report that you guys put out was the United States versus itself. And here's what you guys all wrote. The U.S. presidential election will worsen the country's political dysfunction, testing American democracy to a degree the nation hasn't experienced in 150 years and undermining U.S. credibility on a global stage. Remind us how you guys came to that determination to call it the number one risk.
Because President Trump would put the erosion of U.S. democracy on jet skis. I mean, look, if he wins, I think it's more likely than not that he will do so-called Schedule F, turn civil servants into political appointees, get rid of the people he doesn't like, and then go ahead to weaponize the Department of Justice and the FBI. And that will probably hurt American democracy. I think there'll be another election. American democracy is going to continue, but it will be severely tested like it hasn't been since the Civil War. I mean, we've really got another Civil War on our hands if Trump wins.
Another Civil War on our hands.
Yeah.
What do you mean by that?
What I mean by that is that I think we will probably see unrest, significant unrest in the major cities on both coasts. That is the kind of pulling at the tissue of what makes us an American democracy. The American democracy is ripping the tissue apart. Will the body survive? I hate to be sort of metaphorical about that.
Right.
Yeah, it would. But we're in for a tough ride.
Hey, Cliff, to be fair, there's lots of polls out there that say that most Americans aren't really happy about either choices at this point. And as we often say in the investment world, the past performance is no guarantee of future results. So we don't really know what a second term would be like for either Donald Trump or Joe Biden. But for Donald Trump, and to be fair, his policies, whether it's China, immigration, are something that continue to be talked about and dealt with. We understand that there are issues, significant issues, even in the Biden administration. They have continued. So I guess, to be fair, we don't exactly know what it would mean. But I wonder if you're saying that no matter who's in the White House, it's a test for democracy.
I think this year will test democracy. And that's sort of the front-loaded part of what we were saying, that this will be a very nativistic, very visceral campaign. And yeah, to be fair, I think some of former President Trump's policies were good for markets. One could even say constructive. In my own view, I think Biden's been tougher on China in many ways than Trump was. But I think this country's so polarized right now, that if Trump's elected, you'll have Democrats really not buying that he's a legitimate president because he should have been in jail. And, B, I think he's going to bring in, the Heritage Foundation. There's a lot of think tanks out there going to staff him with, I think more loyalist far-right people than he had the first time around. So, I think there's a good chance that we're going to get more extreme policies than we got the first time.
And to be fair, there's certainly many cases, and ongoing litigation with the former president that we're kind of waiting ultimately for the outcome to see what happens. So just to kind of put that out in the center.
He faces 91 felony charges in 4 separate cases. They range from conspiring to defraud the U.S. in his efforts to overturn the 2020 election loss, to falsifying business records to cover up hush money paid to an adult film actress. So they really run the gamut.
What I want to ask you is, how can we all as Americans, we are the voters ultimately, we pay taxes, we employ everybody who's down there in Washington. What's the role that you think Americans need to play in this division, or trying to fix this division?
Yeah, sure. That's a great question, and one I love answering. So look, put up with it short. When I was on vacation recently, I was in West Virginia and called, I won't say the county, but the executive committee of the Republican Party of a very conservative county. Met them with my 15-year-old son for lunch. And I think I told you guys, it was a fascinating discussion with some West Virginians who felt like they had seceded from the United States of America. A. B, I was the first person from Washington they had ever talked to. And they didn't want to secede from the United States of America. So I think there is a national conversation that we really need to have. I feel lonely when I call for that because the Democrats aren't calling for it and the Republicans aren't calling for it. But I think this kind of national town hall would be a really constructive thing to try, because Americans are good people. I think we're just really polarized.
Hey, go ahead, Carol.
I just want to mention on AP News Alert, United Auto Workers Union endorsing President Joe Biden for re-election as the Democrat works to win over the rank and file. So we know he has been, many would say, a friend to organized labor. We've seen him out there certainly supporting them.
Well, Cliff, speaking of business, I mean, that's what you do at Eurasia Group. You advise businesses about how to handle the political climate, the geopolitical climate of the U.S. and of the world. One, what are you hearing from CEOs right now about a potential Trump second term? And two, how are you advising them to navigate it?
Well, what we're hearing is a lot of interest in, what a Trump 2.0 would do on tariffs and on protecting certain sectors generally. Is there a, trade to be made on a 10% universal tariff, that kind of issue, or on revoking PNTR, preferred trade status from China? Firstly. Secondly, there is a lot of concern in C-suites and corporate boardrooms about the issue of instability on whether America's status as the ultimate safe haven for capital in the world, and capital's a coward, only goes where it's comfortable, is that going to continue to be the United States if Trump gets elected? I think there's a lot less. There's an assumption that Biden 2.0 would be like Biden 1.0. So I get a lot less questions about Biden being reelected than I do about Trump. A lot of interest in Trump, though.
Is there, just in 30 seconds, does it seem to be that executives are supporting Trump to a different degree than they were the first time around? Just 30 seconds left.
I think that a lot of previous Trump voters are kind of scratching their heads and saying, look, I prefer what this guy would do on markets. I prefer deregulation. I like that. But am I going to have to put up with a degree of instability and lack of confidence in the country that is going to hurt my bottom line if you look triple net? So I think there's more doubt, I would say, even among formerly pro-Trump Republicans.
All right, we're going to leave it on that note. So glad we got some time with you. Cliff, thank you so much. Happy New Year again. Cliff Kupchan, chairman at Eurasia Group, on Zoom from Washington, D.C.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So I wonder if U.S. consumers are kind of loving the outlook and how they're feeling about the world.
Well, you might recall last week, U.S. consumer sentiment soared in early January to the highest since 2021. That far exceeded expectations. Short-term inflation expectations also slipping to a 3-year low. So I'd say, feeling pretty good. Yeah, at least by that measure.
That was a big number, right? Kind of surprised the world, or at least folks here in the U.S. So consumers upbeat. And on that, our next guest in our team is out with a new consumer stress index. So let's get to it and really find out how stressed out consumers are, or they might not be, is Katie Thomas. She's head of the Carney Consumer Institute. She's on Zoom from Pittsburgh, Pennsylvania. That institute, by the way, it's a think tank of global strategy and management consultancy folks. Katie, good to have you here with Tim and myself on Bloomberg Businessweek. First of all, give us some background on the index, how you determined what needed to go into it, right? And this is the first read on it, or give me some background here.
Yes. So thanks, Carol. Great to be back with you and Tim. And yes, exactly. This is our inaugural Consumer Stress Index. And really, it is our take on consumer sentiment, but a little bit more expansive. So we were inspired by consumers increasingly being labeled as unpredictable because the behavior for a while up until recently wasn't tying out to traditional sentiment metrics. And really, our challenge was two things. One was that we were looking a little bit too narrow on very specific economic and financial metrics. And the other piece was we weren't getting their input in a broader sense. So again, it was very much like, how do you feel about the economy, not what's going on in your life? What are the other things that are perhaps stressing you out? Or, in fact, we found the opposite, which is that consumers have this optionality that has allowed them to navigate some of these stresses a little bit better than perhaps we were giving them credit for. So it's really this comprehensive point of view on consumers and their stress.
What's the optionality that they have that you're referring to?
So when you think of something like, we talked a lot, of course, over the last couple of years about food inflation. When you talk to consumers, you realize, in fact, they feel like there's more flex there than you may think. So yes, certainly they acknowledge the rising prices, but there's a lot of options in terms of where you shop, what brands you buy. You can try new brands. You can try different pack sizes. You can maybe there's something you eliminate. You go out to eat a little bit less, but it's not all that upsetting to you in the grand scheme of things. Or similarly with interest rates, it's, yes, I acknowledge that I can feel the strain of these, but I don't feel like I'm unable to do anything about it.
I'm curious too, Katie, like certainly in the investment world or economic world, sometimes we, create something's created and they do back testing to see how great an indicator it is of whatever. And I'm just curious, is that what you guys did with this index? Were you able to?
Not fully because of just the way that we built it. So we did the best we could, but in building out the index, so we have these 5 pillars. So we have consumer, wallet, and finances, but then health and education, innovation and technology, food and the environment, and geopolitics and government. And some of those statistics just aren't as well tracked as economic statistics, as well as our consumer inputs and overlays. So we asked consumers 40 survey questions and unfortunately can't go back in time. So we're optimistic that our research will only get better with age.
Why did you think it was important, though, to do it right now at this specific time here? You could have done it a couple of years ago. You could have done it pre-pandemic. Like, I'm just curious.
Yeah, I think truly we felt like coming out of the pandemic, this is the most we've heard CEOs, even in calls, kind of say very fuzzy things about the consumer and not always wanting to fully admit unpredictability, but saying things like, oh, we're getting mixed data on the consumer. And it was really coming out of the pandemic and trying to understand as people's behaviors settled back down. And again, really those gaps that for a while the consumer sentiment numbers were down, but consumers were still spending. But if you talk to them, they were blue, but in reality, they were still out there, and just try to rationalize some of those inconsistencies.
So answer the question for us based on this research that you guys recently did at Carney. How is the consumer doing?
Right now they're actually doing pretty okay. So in the U.S., we have a baseline of 100 since 2019. So we backed the macroeconomic data to 2019 as our foundational starting point. And the consumer right now is just up about 103. So, they're feeling okay. There's some stressors, but a lot of that, frankly, is driven by geopolitics and government. So one of the things we looked at when we talked about this optionality was, does a consumer feel like with some of these stressors, they're able to respond to or impact them at all? And with things like global conflict or political polarization, those are things that are weighing on them that they feel like they have very little control over, unsurprisingly. And so that's something that I heard you all mention the election coming into this. That's something we'll be keeping an eye on the next few quarters as we see how that impacts the overall stress.
So if you say overall, Katie, the consumer is doing pretty well, it seems to me that there's this disconnect between how consumers feel and how they say they're feeling, well, at least when it comes to politics. Because what we do see over and over again, at least in the polling that Bloomberg has done in recent months in several swing states, is that when it comes to how consumers feel about the economy, it does seem like former President Trump is polling higher than President Biden. And we're trying to understand that disconnect at a time when, well, the economy by many measures, including your own, is actually doing pretty well. How do you explain that?
Yeah, I mean, there are some of these data points. I agree with you. Tim, we're trying to validate as well, because there are studies that show that when you actually do a party line split on how people feel about the economy, the negative numbers are very much being driven by Republicans.
That's
and so
interesting.
you're seeing whether that's, because they're in, perhaps just an echo chamber of kind of affirming these affirming things, or perhaps even, intentional sandbagging of those numbers as we think about where we're at politically in this country. I mean, that's part of what's driving some of this. And so that's why our aim with some of our questions was almost to ask very objective questions that didn't allow for that again focused on this optionality as opposed to just focusing on the feeling, because otherwise you do end up with the say-do gap you described.
Well, it is right. Exactly. So interesting, this idea that, right, you say one thing, but you do something completely opposite. So then, all right, how good are the data points? Having said that, so 24,000 consumers in 12 countries are who you spoke to. And so what did they find as the thing that was most stressful?
Yeah, absolutely. We talked about geopolitics and government. That's really across countries right now. You think obviously Israel and Gaza, Ukraine, and you know all the different impacts of that. If you're in Europe, you're feeling perhaps, and that's what we were building with this index too, was the interconnectivity of those 5 pillars. So in Europe, you're feeling the stress perhaps of Ukraine, but also the impact on your energy prices. And similarly, that's really, and again, it goes back to that struggle for like control and just the lack of it. But what we're really tracking for, looking forward, and for our brands and clients, is what does that mean? So it comes up to topics like, purchasing behavior. How is that affecting how people are purchasing things? Brand boycotts we've seen in the US more and more lately. And so it's really working through some of those risks and helping to prioritize.
From a politics perspective, what stresses people out?
In the US, it usually is just that general feeling of polarization. Like there's no path forward. There's no path of togetherness.
We just spoke with Cliff Kupchan about this over at the Eurasia Group. He's very concerned about the divide in the country. He's concerned about a civil war breaking out.
Exactly. I think that's really what we feel from people, is just like far and away, those were the highest numbers we saw. And just really weighing down on folks. And it's this generalized anxiety. You can split a lot of these metrics as well into more generalized and then personal things, right? My personal finances, my personal situation with healthcare and education. When it comes to politics, it's this like kind of shared sense of discomfort.
It's interesting too, and you guys, in a release that was also put out, the initial baseline report, surfaced some interesting conclusions. For example, while stressors associated with the consumer wallet pillar were most frequently cited, 70% of respondents did not list that as their primary concern. Like, how do you cross that one?
Well, that was honestly one of our early big unlocks of this work, was that we have those 5 pillars, and consumer wallet and finances did win, but the rest, 20% of people said geopolitics and government. Another roughly 15 to 20% said both health and education and food and the environment. So it's sort of one of those things like, I'm not worried about interest rates as much as I'm worried about my food access. Or right now I'm going through a healthcare situation and that's weighing me down more than, again, like even wages, or as long as I'm employed, that's actually not my top concern right now. And that's exactly the kind of thing we wanted to uncover here, of just how people's kind of full plate was working in their mind and where those kind of trade-offs and give and take was occurring.
All right. So you all consult, you advise, you have clients who reach out to you. First of all, what are you hearing from your clients?
I think that it's really just this comprehensive view that really excites them, because it just brings on a lot of discussion around any kind of topic that may be on their mind. So one thing, for instance, we've been chatting with some of our food manufacturers is thinking about the impacts of Ozempic and other GLP-1s. And so even this helps to frame a discussion around, that's not just a conversation about food or basket size. It affects the healthcare system. It affects, how people feel about their like physical and lifestyle choices, even their mental health. And so it really helps to draw some connectivity amongst these major topics that a lot of our clients are talking about.
So it's interesting, Katie, because I think, Tim, think about some of the stories that we've done over the past year, certainly on this this Ozempic craze, this new class of diet drugs, whether it is, clothing manufacturer,
airplanes,
airplane seats,
like airplanes, this being bullish for airlines because people weigh less, so they use less fuel.
People shopping differently in terms of obviously food and so on and so forth. It's kind of real. And it sounds like, Katie, what you are hearing, that's true, that companies are thinking about how they have to adjust their strategies.
Absolutely. There's always, many aspects that it addresses and just downstream implications as well. For instance, the one that came up the lowest of consumer stress here was innovation and technology. So that's just ultimately not bubbling up in the US. In most countries, but in particular in the US, people aren't as worried about generative AI as they are about, again, some of the other things like putting food on the table, which makes sense. But there are still downstream implications there where it may not feel as immediate, but it still could have an impact on their job, on their life. So it's really trying to carve out all of these different key items that are really impacting a consumer at a macro level, but also that our clients need to think about.
Hey, we've been spending a lot of time this week talking about the biggest risks that the economy is facing this year. In your opinion, based on this research, what do you think that is?
I do think one is going to be managing through the U.S. election and other elections around the world, and how we kind of navigate that and the resulting impact of consumers, kind of reacting to that. And what we're working on is drawing that directly to consumer purchase behavior. So, our next run of this will be in March. Already, we're hoping to see some changes there and see how some of these things may flow through. And then I do think from an immediacy sense, we're still this year going to be keeping an eye on some of those financial metrics. So, keeping an eye on housing costs, interest rates, how those continue to evolve, and making sure people still feel like that they have that optionality. Because if that goes away, that's when we'll see stress levels tick up.
All right, we're going to leave it on that note. Hey, listen, Katie, so great to spend some time with you and do a deep dive on this. Katie Thomas is head of the Carney Consumer Institute, joining us on Zoom from Pittsburgh.
This is Bloomberg Businessweek, insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, everybody, we are staying with earnings. Just a quick headline. IBM crossing fourth quarter revenue $17.38 billion versus an estimate of $17.29 billion. So just want to mention that, and we'll continue. That stock is up about 4% in the aftermarket. Let's go back to Tesla, because it's down about 4% in the aftermarket. Numbers just out. And I think the real concern is about the outlook and what we might see ultimately, Tim, here this year.
Okay, so these numbers are worth repeating. Fourth quarter revenue coming in below estimates, $25.17 billion versus estimates of $25.87 billion. Fourth quarter free cash flow, $2.06 billion. That was higher than estimates at $1.45 billion. Fourth quarter gross margin, though, that took a real hit, Carol, 17.6% versus estimates of 18.1%.
All right, Tesla to start a next generation platform production at its Gigafactory in Texas. Teams to work on a launch of a next generation vehicle at Texas, and continuing to make progress on a next generation platform. So a lot of stuff that is to come. So let's get to it, because we've got a great roundtable. Red Brown is Bloomberg News earnings reporter. He covers the numbers and will give us some more insight into what we just got. Ross Gerber is with us, president and CEO of Gerber Kawasaki Wealth and Investment Management. They have about $2.2 billion in assets under management, including about $84 million worth of Tesla stock. You folks know him well. He owns Teslas. He invests in the company. He sells at times. I do want to start with you, Ross. Are you concerned? Stock's still down about 2.7% in the aftermarket, but when Tesla says 2024 volume growth may be notably lower than 2023, I don't know. Does it worry you a little bit? Does it make you want to sell any stock?
Well, I don't want to talk about our trading because I'm not allowed to, but if you look at our, my fund GK, we've been selling the stock over the last several months, as well as if you look at our public filings, we've been lowering our position over the last several months. So there's a lot of clients of mine who are very upset with some of the things Elon said and sold their stock in the $250 range that are probably pretty happy they did that today.
Ross, stick with this for a minute, because you've been pretty critical of Elon Musk lately, which has been a marked difference from how you've been over the past few years. I mean, you were among the biggest Tesla bulls out there. But now you're concerned. You write that Elon's becoming the Kanye of business. Is this what's hitting the company's stock? Or is this a bigger question about what we were talking about earlier with EVs, EV demand falling, and what we're seeing from Ford, what we're seeing from GM? Is it a bigger issue outside of Elon's control?
I think Elon's created the issue for EVs across the board more than it's an EV issue. But the bottom line is, and you see it in the numbers, and this is what we were kind of waiting to see, is that margins continue to go lower. They're basically not able to sell cars unless they lower prices because Elon refuses to advertise. And then the advertising he's doing are trips with his child to Auschwitz and, anti-Semitic and racist comments all the time. And him, basically using X as a platform for every political debate possible that he could get himself into, which is exactly how you not sell cars. So God forbid they actually got him off Twitter and advertised, maybe Tesla's problems would be solved.
Interesting. Hey, I want to bring you in, Red Brown. things that you're seeing and noticing. We've been breaking down the earnings with our TV colleagues. The key point that you're focusing on.
Well, I think obviously the production target, notably lower volumes for next year, it does raise some questions about this strategy of continuing to lower prices. They lowered prices just last week again in Europe, so it seems like that is going to be the strategy going forward, but it doesn't seem to be kind of paying dividends in the company's view going forward in terms of actually selling cars still.
Yeah, and Tesla less bullish on its Cybertruck, noting in the investor deck that its ramp time will be longer than for the other models given its manufacturing complexity. So it's also adding that. All right, Ross, so can definitely, respect your different tone here in Tesla. So I don't know, how do you think about this company going forward? Is it a case that it's hard to kind of remove the man and the creator from kind of the company, but how do you do that? Or do you do that at some point?
Well, what I've been saying is that the Tesla story has just changed from what the story was a few years ago before Twitter. And as long as investors are comfortable with that story, then the long term for Tesla, the story is still intact, whether it be charging, energy, EV. Tesla's the prime player in this climate change revolution that they began. And the real issue is the company is being mismanaged now by the CEO, who's demanding a massive compensation package, but won't do any of the things that the company needs to really resolve their sales and margin issues. So I think as we move forward as investors, it's really about what is the right valuation for Tesla, because Tesla's been the highest valued of the Mag 7 or one of the highest valued tech stocks for years, and before he bought Twitter, it traded 100 times multiple of future earnings. Today, it's trading at 60 times multiple of future earnings. But now that future earnings number is definitely in doubt. And does it really deserve a higher multiple than NVIDIA and Microsoft? And I think that's what's hurting the stock, irrelevant of the company.
Stock's still down about 2%. Hey, Tesla also noting, Ross, that they have reached the, quote, natural limit of cost down of our existing electric vehicle lineup. It's kind of corporate speak, but what does that mean?
Euphemism for we can't lower prices anymore?
What does that mean?
It's like we have reached maximum efficiency of production. And so basically every time we discount, it's just going to cost shareholders more. Now, the good news is this is great for Earth because people are getting cheaper and cheaper, EVs, which, are great. The bad news is it's coming from shareholders' pockets. And so if you're a shareholder, it's time to really assess, does this company deserve a 60 multiple of forward earnings? And I think that's what investors are going to be doing over the next several months.
Okay, I want to bring back in Red Brown because he's been watching the numbers come out. Red, what else sticks out to you? I know the looking at the production numbers certainly sticks out. Anything else in these numbers here? We're seeing shares down about 2% as we speak.
I think everything that we're seeing right here from the numbers is that this is kind of the cost you pay for the game that they're playing of continuing to cut these prices. Yeah. You're seeing a bigger and bigger disconnect between their top line growth and their earnings growth, right? They did hit record revenue. That's going to get lost in the shuffle here today. But it came at the expense of over 40% drop in their earnings, right? So it doesn't seem like it's the path forward. I think Ross is hitting on some interesting topics here as well, as kind of where does the growth come from? A lot of the share price is predicated on some of these sort of pie in the sky initiatives, be it AI, huge question marks over that, right, with whether or not Elon does that inside the company or not. So hopefully get some more insights on that when the call goes later today.
Ross, what is the number one question on that call today in your view?
I think from my perspective, it's kind of what we're hitting on right now, which is where's the growth coming from? If you're not going to grow cars by a lot, this is not a good thing. So I think my concern is 4680, and this is the story behind the story, which is one of the scaling issues they're having with cyber and semi is that 4680 is just not working as quickly as they had hoped. And they planned all of production in Texas around 4680 originally, and they've now had to pivot. And so this has caused extra costs, lots of complexity issues, and I don't think they've mastered 4680 yet, or even close for scaling at any mass level. And this is a huge detriment to Tesla moving forward because they have to get this technology right to ramp cyber and semi, which is where growth will come from.
Hey, 20 seconds really quickly. What do you mean 4680? Really quickly.
These are the new cells that that they built for EVs, and these new cells are 7 times more powerful, much more efficient, charge faster, and they're wonderful. But they haven't been able to scale them as quickly as they'd hoped.
All right, good stuff as always. So appreciate it. I know you've had a busy day. Our thanks to Ross Gerber, President and CEO of Gerber Kawasaki Wealth and Investment Management, and then of course our thanks as well to our Red Brown. He's Bloomberg News earnings reporter right here in studio. Tesla shares back down about 3.7%. We're seeing in the stock fall here in the aftermarket.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. Just got about 18 minutes, 17 and a half minutes. Let's
Good
call
counting.
It. Yeah, I'm watching the clock.
Very impressed.
Time continues as you speak.
It does. And there's like a little bit of a delay too.
Yeah.
When it gets to our listeners. It's got to go through the tubes, fly through the air.
We're coming
as
up
the signal
on
does.
17 minutes away.
Okay, well, that means it's time for Drive to the Close. For that, we go to Bryant Van Cronkite, portfolio manager at Allspring Global Investments. He joins us from Wisconsin this afternoon. Bryant, good to have you with us. I want to know what worries you, because it doesn't seem like investors are worried about a lot right now. We're seeing a lot of records today. Meta Platforms, Microsoft. We're seeing Netflix surge. What's going on?
Yeah, good to be with you again today. Look, I think the market really has embraced the optimism that comes with a typical monetary loosening policy, right? We're not even quite through the tightening in my mind, and the Fed has given us a reason to believe in a preemptive cut that's going to lead to stimulating the economy. And we've had a classic playbook of buying cyclicals, buying beta, buying operating leverage, and that's played out. And stocks have rallied coming into the beginning of this year. Now we're starting to see that fade a little bit.
Don't you think, Brian, the Fed has been kind of reining everybody in? Although the Fed talk of saying, wait a minute, slow down, higher for longer.
It was interesting, right? Because they came out at the end of the year giving you reason to be optimistic about the cuts. And I guess this is our, 6th iteration of the market trying to push the Fed into this early cut pattern that we're looking for now. But every time they come back and they walk us back and saying, oh, wait, the data is still coming in. We're still not done yet. The risk is still that we haven't gone far enough. That's my view. My view is the market now has embedded a lot of optimism, and the reality is we're not done yet. We're not sure what's going to happen. And so I don't want to own businesses today, and I don't want to buy sectors today that are reliant on the generosity of the Fed. I want to buy businesses that are controlling their own destiny. They're navigating the markets by investing in growth.
I want to get to some of those businesses in just a minute, but before we do that, I just want to know what you think the Fed is going to do in terms of cuts this year. How many do you think the Fed will do, if any?
I think the reality is they have no idea. And so I certainly have no idea, right? I think they need to figure out what's happening still with inflation. Does it sustainably come down where it is? What happens with labor markets? That's probably the biggest one. If we move too early from a monetary loosening standpoint and labor markets haven't resolved themselves from a supply-demand situation and wage growth then moves higher again, that's really bad. It's really bad from a sentiment standpoint. And once sentiment expectations get out of control, the wheels come off very quickly. So my view is the Fed has no idea. And they're going to be very careful about being inactive during an election cycle. So they came out early saying this might happen, but the reality is they don't know yet, and I don't know yet. So guessing at it, I think, is a futile effort.
All right, so let's get to what I care about is when somebody comes in with names, and I want to know kind of where you would be committing new money.
We got names, Carol.
We got names. So let's get to it. Because we're going to actually get SL Green, a big player in the REIT market, especially New York commercial office real estate. We're going to get those earnings after the closing bell. CBRE Group you like. Talk to us about that one.
Yeah, CBRE is a great business we've owned for a long time, but recently have increased our position because we like what they're doing to navigate an otherwise very challenging time. Investors punished the stock as rates rose because there was a lack of price discovery. Buyers didn't want to sell properties at the lower rates that the higher levels that sellers wanted, and vice versa. And so there was no transaction volume. And so the earnings of CBRE fell as leasing and sales transactions dried up. But the reality is that's only half their business. The other half is a very high recurring cash flow business, and they're using that cash flow and their great balance sheet to invest in the future. They recognize the macro slows down their business today, but the reality is, as a long-term investor, what are they doing to drive much higher earnings power over the next 2, 3, 4 years? And what they're doing is going out there and hiring some of the best talent in the best markets across the country. And as the rates stabilize and transactions pick up, they're going to have a much higher market share. And as they're buying back stock, the per share earnings and cash flow power, we think, will double versus prior peak in just a few short years. That, to me, is a really interesting opportunity when the market's being very punishing their stock today.
So is it a bet on lower rates, which are good for the real estate names, and an economy that's growing? Is that the bet?
You don't need that. You don't need that to win here. That would help, right? That would accelerate the value creation. But what we're doing right now is we're building a base of talent. We're building an opportunity set the market's mispricing today. So when rates do stabilize, not fall, but when they stabilize, there will be more transaction volume in commercial real estate, everything from offices to hotels to medical properties.
But that's what I'm saying. Longer term, the bet is on that you've got an environment that's growing in terms of economic growth, but a lower rate environment.
Doesn't have to be lower, it needs to be stable.
Okay.
Because when they're stable, buyers and sellers know where expectations are and they meet. I don't really care if they're selling that property for $500 million or $450 million. CBRE gets their cut, and they're going to have a lot of cash flow off that. I just need it to stabilize, and everyone will then come to the table again.
That's because they're on the service side of it, right? Is that why you say that? They just get their cut?
No, that's the transaction side. That's the transaction side.
Transaction,
the service side remains stable. That's growing. They're growing that double digits right now. But the focus from the market is on the transaction side. Again, lower rates accelerates. It puts fuel on the fire.
Got it.
But we don't need it to win. Over the next 3 years, we need a stable, predictable rate market, and buyers and sellers will come back to the table and transact.
All right, so I want to move on to another stock, Keurig Dr. Pepper.
Got a segue from real estate too?
How about some 7-Up, Carol? How's that?
Not so good.
RC Cola, Big Red, of course, Keurig Dr. Pepper, Snapple Tea, Canada Dry, Green Mountain Coffee. The list certainly goes on with Keurig Dr. Pepper. Why are you bullish on this company?
I'm bullish on it because they've been doing a really good job managing two very different businesses. There's the cold business, which you talked about, some of those great brands on the soda side. We're seeing tremendous pricing power. You're seeing demand stay stable, and they've navigated the pandemic and all the way past that really effectively. What the market doesn't like right now is how the hot side, the coffee side, has been behaving. At-home consumption skyrocketed during the pandemic for obvious reasons, and it has come down a little bit. So volume growth in the pod side has slowed.
Yeah.
And also they've had issues with their pricing relative to their costs. In many industries, including the coffee manufacturing industry, costs to manufacture have gone up, but the contractual pricing agreements they have take time to roll through. And so margins compressed in a pretty material way. We're almost through that now.
Okay, so I was going to say, if you look at the stock, it's really been in a rut since the end of 2021, down about almost 10%. It really kind of hasn't been able to kind of move. It's basically where it was a couple of years ago. So you're saying all of that is done and we should see some upside here?
Right around the corner in my mind. It's also a function of what we've seen with the staples in general. When people get excited with the economy, why would you buy a consumer staple? Right? Money has flown out of this category, but as it does for macro reasons, from a micro standpoint, it's our chance as stock pickers to really add alpha. And so in my mind, we're going to start to see a quarter or two here, we'll start to see that margin inflection on the coffee side, which should drive higher earnings and get the market focusing on the true cash part of the business longer term.
All right. Well, fun to talk names as always, and good to get your macro as well. Bryant, thank you so much. Be well. Bryant Van Cronkite, portfolio manager at Allspring Global Investments, joining us from Menominee Falls, Wisconsin. Interesting. I love talking names.
I don't know how many times the Fed is going to cut rates this year.
Well, I think that's a silly parlor game, partner. They're going to do what they're going to do. They're going to watch the data.
But that is why, I mean, that's literally what people are betting on right now.
I think it's going to be a while. Yeah, I know, but I still think it's a silly parlor game.
Fine.
I'd much rather play, what is it? Tesla bingo? No, Elon.
Yeah, Tesla bingo. Elon bingo.
Musk bingo.
Well, get out your bingo card.
Get out your bingo cards, everybody. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.